And the problem I see with some of the money managers is they have this general 4% rule. You're basically drawing down about 4% of your total savings to survive. And if you don't have a large bankroll or a large amount saved, with today, the cost of living, it's not going to cover it. It's really outdated. And I look at it this way. If you've got X amount of dollars, you want to make sure that money is going to last not only you, but you have something to leave behind for your kids or your grandkids.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Mr. Jay Patel, thank you for being here on the show, Path to Passive, real estate investing for tech professionals. You've got a really cool story to share. And I really like the topic that you're talking about here too, as it's related to your story as well. Right before we started recording, you were talking about how, I'll say, your age group and how you've been serving a number of your friends from college through your career, through your life, as they have been reaching these pre-retiree years as well. But what I really want to start off with is just tell us a little about how you got started with real estate, because you've done things like invested in multiple different asset classes. You're overseas right now from watching. You can see it's dark at nighttime behind Jay right now, and out there to launch India's first MLS, which is really cool to hear about. So let's start how you got started in real estate.
Okay. Well, first of all, my nationality is Indian. It's in my blood. I'm a businessman. I'm a serial entrepreneur. I actually kind of stumbled into real estate. Coming out of college, believe it or not, I ended up becoming a trader. And knock on wood, we did really well at the time. And I was in my 20s. This is going back to like 1993, 94, 95. And making like $250,000 a year back then was a lot of money. And so the problem though is when you're young and you make that kind of money, you don't really appreciate it. You haven't gone through that laundromat that life will throw you. And anyway, long story short, I ended up not only doing well with that, I opened up my own firm, which was an investment firm, like an actual brokerage company, but I also had a hedge fund that I managed. And it was not a huge hedge fund. It was a smaller one, about 150 million bucks. But all that led me to, this is, again, keep in mind, I was only like in my late 20s, early 30s. At that point, I was investing in real estate more passively because I had to put money somewhere. And when September 11th happened in 2001, I took it on the chin because we were a fairly aggressive fund. We had quite a bit of exposure and we used leverage. It's a bad combination when something like September 11th happens. Long story short, that year I took a sizable hit. And for a 30-year-old to take a $2.5 million hit, that's pretty significant. And it was devastating to say the least, right? Even now, at my age right now, I really couldn't afford to take a massive hit like that. But at the time, I didn't realize that. I just felt like you feel like you're invincible, right? You've been making great money, you're young, until you learn these life lessons. And I always say, the best lessons you learn are from your losses. Wins are great, but the problem with wins are you go along thinking, oh, this is easy, but it's not easy. And life will throw you some curveballs and some lessons. Long story short, after 2001, I'd taken a big hit. We ended up divesting out of that fund. We had a lot of redemption notices because much of our capital came in from Europe. And at the time, they didn't know what was happening. They didn't know if this was going to continue. It was just the first attack. They didn't know there's going to be multiple other attacks. The market was closed for a number of days before it reopened. And when it opened, it was over 1,000 points down. So anyway, I ended up taking a year off, basically, just to kind of reassess where I'm at. I had all my eggs in one basket. And that's lesson number one for anybody that's listening here, especially if you're a pre-retiree. In your portfolio, you should not be heavily weighted in any one sector or any one area. And that's what we also employ, that philosophy, in our fund management. Even though we do real estate, there's so many different forms of real estate. In fact, the fund, Propex, so the name of the fund, this particular one I'm talking about, is called the Propex Income Advantage Fund 1. And we have 3 different verticals. We can talk about those as well. But going back to the story, I decided at the time that one thing that's always worked for me, even though it's not sexy and exciting, is real estate. Like I hadn't really ever lost money in real estate like I had in the market. And I said, what I learned at the time about multifamily apartment buildings, I said, I can actually scale this business and do equally as well as I was doing potentially in the market. And more importantly, not be susceptible to the crazy volatility that the market provides, right? It's more predictable. compared to when you're young and you had all that you suffer that big loss. The one thing you don't want to do is now be in that environment. You want to get to a point where you say, okay, this was great, but I don't know how much more of this I can take. It put a strain on my relationship with my wife and our family, and we had 3 young, we had 2 already and a third on the way when this happened. So we had to really refocus. So that's how I ended up getting more into real estate. And you asked, how did my journey start? It started with that. We bought some single family homes. We did some foreclosure type of transactions. We actually bought a couple that there's one property we bought that was a 16-unit apartment building in Detroit out of foreclosure. And then we ended up, getting it all fully leased out. So I like the combination of buying something well below market value, where you're going to be able to do some forced appreciation, update the units, and then raise the rents, and ultimately either exit or just keep it for the cash flow. So we did some of those transactions. Another lesson learned is don't go into markets that you don't feel comfortable sending your wife or your son or daughter to collect the rent. I made a couple of mistakes where these are early on. These are, like I said, life lessons that when you finally take a hit is when you realize, wait a minute, it's not worth it for those areas. So we had some Section 8 properties, which are great and from a cash flow standpoint, but the area, so it was on the south side of Chicago, and you probably heard stories about Chicago. By the way, Chicago is my hometown. And south side of Chicago, when you buy these properties, you don't get a lot of appreciation, but the cash flow is fantastic. So if you're looking at it from the perspective of return on investment, it looks great. You're getting, sometimes they're at a cap of like 12, 11, 12, 13. But you have to do that to incentivize the investor to be able to buy that. Otherwise, who's going to go in and buy a property that's going to make 7 or 8%, no appreciation, and then the risks involved. There's a large turnover in these type of properties. So long and short, I say, look, good investment properties. I don't necessarily need to go into an A class building, but I like B and C class because it's a good blend of both cash flow and appreciation. So that's what I did when I got started. Since then, I've built a fairly decent portfolio. I'm at a point, like I said, I'm 54 now. I don't really have to work. I love what I do. And so friends have come to me and said, hey, Jay, how did you do this? What are you doing? And these guys are all very successful, right? I mean, a lot of my peers have done really well. They're in corporate America, climb the corporate ladder. Some of them have moved and get, all these headhunters are always coming in and poaching them from these companies and giving them getting them a bigger salary, and they move on. I know that's pretty prevalent, especially in the tech space, and it's great. But the problem with a lot of these guys is that, I wouldn't say the problem with them, but the thing is that they're so good at what they do, but they won't really know what's happening on their retirement side or on their portfolio. So they typically just either put into mutual funds or they have a money manager. And the problem I see with some of the money managers that I've talked to in the past, and even some of the guys that have come over to me, is they have this general 4% rule. And 4% rule, if you look at it and how it's structured, you're basically drawing down about 4% of your total savings to survive. And if you don't have a large bankroll or a large amount saved, with today, the cost of living, it's not going to cover it. So you should.
Yeah, outdated, right?
Yeah, it's really outdated. And I look at it this way. If you've got X amount of dollars, you want to make sure that money is going to last not only you, but you have something to leave behind for your kids or your grandkids. So what we decided to do is, when I started helping a couple of these guys who came to me and said, hey, Jay, can you help me build at least some type of a portfolio that I can at least get some passive income, and I'm building equity, then hopefully something happens to me, I'm leaving something behind for my kids. And I was doing something similar like that. Basically, I have 3 kids. My goal was to have essentially like a trust with each one of them having like 10 properties. I feel, look, and they all know, they all understand because they've grown up in this environment. They've seen us do real estate. They have the choice at that point if they want to hold on to the property and they want to manage it, and they can and just take the cash flow, or if they ever need it for like a rainy day or they want to make a big purchase, they can sell the property. And by that point, it's already fully paid off. So that's what was originally the plan for me. And they saw that I was successful, at least to the point where I would have enough passive properties that I'm able to live off the income. And so I started doing it for a couple guys and showing them, look, you buy these type of apartment buildings, help them find the right ones. The downside of that whole strategy is it's not scalable, and it takes up a lot of my time. So that's when I went to them. I said, listen, guys, this isn't going to work. And also, let's say, Steven, you might get 12, 14, 15, maybe even a 20% return per annum. Another guy might get 12 or 14, and we all meet all the time. So it's like, hey, why is this guy getting a better? I can't control that, but it's all individual. The number one thing I tell you is diversify, have more than one investment. And I said then at that point, look, let's just set up a fund. You guys invest in there. Everyone's making money, but there was varying amounts. So we set up a fund, and then they put their capital in. Now everyone's getting the same return. It's all above average, and I don't have to have I'm not distracted trying to manage 3 or 4, 10, 20 different. Long story short, that's how Propex came about. A little bit about Propex. Propex is unlike
Well,
many.
I'm curious, just for a second. You were talking about there was a lot of data points along the way for the story, right? I wanted to ask is that you went from going to be a trader, and it sounded like you were a trader in Chicago since that was your hometown, or were you doing that
I
somewhere
did it. I
else?
was in New York. I got a great
Okay,
opportunity, and then I ended up going back to Chicago. So the short story there
got it.
is I ended up working for a company called Redstone. I worked my way up. I was young. I was still in my mid 20s, and by the time I left, I went from an entry level type trader to because I originally started the business as a broker, and I knew I didn't want to
Hmm.
be a stockbroker. I went into trading. I was doing well, and then ultimately, within a matter of like a couple of short years, I was like running the trading department. It's not because I was that great; it was because of the circumstances. Number of people had left. My portfolio
Yep.
was doing well. I got bumped up, and the industry rewards you if you're doing well. But I realized how much money I was making for them, and then I ultimately decided to open my own firm. So I went back to Chicago, and that's how it all happened.
Got it. So obviously you're exposed to markets, public equities, all the things,
Sure.
but you said as you were getting out of that, you had bought some of your single family homes and then you went to a multifamily.
The first couple I got into were single family. We had, and like I said, some of them were on the south side of Chicago, not really a great investment. We then decided to do a multi unit apartment building. We bought that, and we weren't limiting ourselves just to Chicago. We were looking at anywhere in the Midwest at the time that we find a great opportunity. So then we ended up
Yeah, you
buying this
mentioned
in
Detroit as well,
Detroit,
right?
and the market was a little depressed. We got some great opportunities there. It took a while now. We didn't really get that much appreciation, but we forced the appreciation because we bought it so low that
Sure.
even after we rehabbed it, we were able to get a nice exit.
How many units are we talking?
That was 16. The problem I had, I'll tell you, man,
Okay.
that's another whole another story in itself. The lessons we learned from that, we bought, that was another thing. We hadn't fully learned our lesson yet about going into the specific types of neighborhoods. And that was in central Detroit. I believe, I'm not sure if it was on Mac or I can't remember the name of the street now, but the point is that we owned a few properties there. And within 3 months of buying the property, we had a fatal shooting. Two people
Yep.
were killed, and then we had a mass exodus of tenants. But we used that opportunity then to update all of the units because now we could do it all at once rather than doing it one at a time. And then so we did all that, got the place reoccupied, and then a few months later, a strip club opened across the street. I'm like, geez, can this thing get any worse? And so again, it's not really a place and there's like loitering outside. It's not a place for
Yeah.
families
There's
that
a
don't
lot
want to
of
raise.
blight all around Detroit
So
too.
yeah, ultimately what we did was once we got it stabilized, we got out of that pretty quick.
Got it. Got it. And I was curious, right? Because sometimes the reason why I was curious about the background, how you went from the single family to more, is because there's this thing that happens where people will end up buying as they get into real estate, one single family home, two single family home. They're like, oh man, I need to put more of my own down payment down
Mhm.
or my own capital, and they're like, oh, I can scale doing multi-family, etc. So I was just curious if you had hit something like that in your
We
kind of
did. We
investing
realized that it's
career.
not number one, the amount of effort we're putting into single family homes, we could do a multifamily home and we actually could finance it much easier. So I'm not a huge fan of single family homes, to be honest with you. I think it's unless you're having a package of say 30 properties in a location where you can take advantage of economies of scale, have one management company manage all of them, and you have your contractors that you work with should anything happen. If you've got them spread out all over the country, it's a pain. Like even as recently as a few years ago, we just started unloading all of that stuff. Because I also do within the fund, we were doing well with respect to specific sectors.
Mhm.
But I mentioned that I was a trader years ago. The thing about trading, it never really
Yep.
leaves your blood once you've done it. I still have that. I'm not a big fan of putting a significant amount of money in the market. So my allocation for the market is only about 10%. But once a trader, always a trader, and you've got some investment there. And the thing is, like, we've actually been working on some things that's really exciting, even on the trading front, and the returns are staggering. So we have a real estate fund right now, which is providing a nice fixed 11% return. And I'm just now getting ready to launch a fund for the trading side of it, which is
Hmm.
obviously it's a little bit more aggressive, but the returns are incredible to the tune of in the
Well,
20s. But that's
cool. Yeah, talk to me about what's in. You said there's three different verticals inside of this Propex fund or this income fund, excuse me. And I think it would be really interesting because you have the trading background and you're talking about this other fund as well. I think some other points to touch on what we have you here is not only to talk about the fund itself, but also some of the things that these pre-retirees can be thinking about and why the fund, this income fund, serves them so well. And maybe if it makes sense to talk a little about like how to think about an asset allocation perspective too.
All right, so that's a great question. As far as the fund itself, we have three verticals, and that basically is three different types of investments that we make within the fund. First and foremost, there's a short-term vertical, there's a longer-term vertical, and then there's the third one, which I'll explain to you. It's more on the like a debt vertical, if you will. So the first and foremost, we love foreclosure, short sales, tax deed type properties. We've bought a number of those where we'll buy these properties at 30, sometimes even 35% below market value. I like this compared to the market because in the market, when you buy a stock, you have no idea whether it's going to be up 30% or down 30%. You believe based on what your projections are. But vastly different in real estate is when you buy something at 20 or 30% below market value, you've got comps. So I can pull up any city and I know within relative certainty approximately what that property should go for. So if I see that right, as far as the market rate. So if I say a simple example, if I have $1 million on average, let's say based on comps, based on that size and that location, the property should go for $1 million. If I can buy it for 700 or 650, I mean, it's a no-brainer. I go in, even if I have to spend $100,000, $150,000, I already know that I'm going to make, for example, $200,000. But it's not $200,000. And this is the thing that people don't understand is I might make $200,000 on an $800,000 property that I ultimately say 700 I bought it for 100,000 I put in. But how much did I actually spend in terms of cash? Every return in real estate, for that matter, anything, should be based on how much you actually invest, not what you bought it for. So if I put in only $200,000, let's take 20 or 25% of the 800,000, and I sell it for $1 million, I'm making 100% of my money. It's a no-brainer. So we love those transactions. That's vertical one. That provides our short-term income. But now what we want to do is we want to offset that income with our long-term assets. And these are assets that provide good, strong cash flow. But the other thing that they provide is a nice depreciation expense. That depreciation expense, we use that to offset the gains that we're getting from our, short-term transactions, therefore eliminating a significant portion of those taxes. These are things that the government has put in place for us. Why not utilize it? Many people invest in real estate, they don't really take advantage of the tax benefits. So I feel it's very important to understand when you go into real estate, why are you going into it? And what are all the different ways that you can benefit from it? So we do that. So we have vertical one, which is our more short-term transactions. Vertical two is our longer term. And those longer term ones, there's specifically two areas. Well, I would say really now, one primary area that I love. We're focusing more and more today on residential assisted living. I'm telling you right now, man, this is over the next few years, the demand is just going to continue to rise. Right now, we're at a shortfall of about 1 million beds a year for that sector. And I love the cash flow. It's incredible. Like you think about it, I don't know if you ever looked into this, but the average cost for a person to stay in an assisted living facility in the state of Illinois, for example, the average is about $5,700 to $6,000. That's the average. But the properties that we're talking about are more like boutique, nicer. The average person is paying about $7,000 to $8,000 per person per month.
So that's like what for that size? I guess it depends on the market, but that size is like what, like 25, 35 beds?
Believe it or not, even less than that. So these residential assisted livings are they'll max out at 16. Sometimes you go to 20. It also depends state to state. I mean, each state has its own regulations, and not only the state will have it, then the county will have it. So you got to make sure that it complies with those standards. But the point is that these are boutique, right? Why do we do that? Number one, the big boxes. Typically, a big box assisted living will have 200 to 300 people staying in it. It's a big complex. The downside is that the attention and the care is not nearly as good because you got one employee to 30 residents. Whereas in our facilities, you got one employee to 4 residents. So for the people that can't afford it, like my parents ever had to go, thank God, knock on wood, they're in good health, they're active. They're in their 80s, but they're still active. But should it ever happen that they need to go in, I'm not going to put them in a big box. Number one, I want to put them close to where I'm at. And there aren't any major big boxes that I really like. And two is I want them to get the kind of care that, right? So if for the people that can afford it, definitely. And then by the way, memory care is even higher. It's $10,000 to $12,000 a month. So the cash flow is phenomenal. So for that reason, and even if you own it, so for the fund, we're not in the business of managing businesses. We're in the business of owning real estate and getting strong cash flow. So in the fund, we will own the property. We'll get above average rents in terms of cash flow for that. But the business is managed by a completely separate entity. So that way there's no business risk, if you will. You've got this fantastic asset that's just generating.
Does that mean you have partners that are operators too?
Yeah,
or
we work with
operators?
Yeah, exactly. And the thing is, why would somebody pay us above average rents? Number one, they got a turnkey solution that they can move into right away. It saves them a ton of money. So that they're willing to pay more as a premium for that property because they can go in right away and be up and running. And so it's time and money, right? At the end of the day, the time is also money. They don't need to put up as much capital. They don't need to wait that long to build it on their own. It's already built, and they don't need to, as far as wait for a year or 2 years, and they get up and running. So they're willing to pay that premium for it.
Got it. So that's the long-term play.
Yeah. So that's one. Obviously, we invest in other assets too. Like, for example, we love mobile home parks right now, RV parks. We like storage centers and things like that. I'm not really big on multifamilies today as I was before because I found ways to make better returns in other areas with less headaches. So these are the reasons why I'm focusing more on these type of assets. And that's why I also said, even with the assisted living, we don't worry about managing the business. We love the cash flow. That gives us double-digit type of returns. So now I've got my short-term vertical, I got my long-term vertical. And so as far as allocation, our long-term stuff gets about 40% of the capital. Our short-term stuff is getting about 35% of the capital. So we're at about 75. And then the third vertical gets about 25% of our capital that's in the fund. And what is that? So we don't believe in letting any money sit idle, but also at the same time, we do need money available so that in cash, so that when a great foreclosure opportunity comes along, we can strike while the iron's hot and we can take it without having to go out and raise capital. One of the biggest things I hated, especially with syndications, is you get this great opportunity, and if you're able to close it fairly quickly, you can get even a better price. And you're competing against many different people. Exactly. If you can step in, cash is king in real estate. If you can step in and do a quick closing, they'll even accept a lower price from you versus somebody else who's willing to pay a little bit more, but they need to go through all the due diligence and get
certainty of close.
Exactly. So it's important to have cash on hand. What do we do with that cash? So we have 25% of our entire portfolio in cash. And the reason for that is, number one, we don't have a long-term lockup, unlike most real estate funds. If you've seen, syndications typically will require 3 to 5 years before you can exit.
Or more.
Yeah, 3 to 5 years minimum. Because it takes time to do what they need to do in terms of rehabbing it, updating it, fully raising rents, getting it fully occupied, et cetera. But for us, our lockup is only a year. And we want to make sure, and we also have 2 different classes of memberships in the fund. And that's why it's designed truly for both pre-retirees and retirees. So if you're retired and you want income or cash flow, then you can go and you can actually start with Class B and then move it over to Class A. Class A gives you quarterly distributions. So if you're retired, you're getting quarterly distributions. If you're pre-retiree, you should take advantage of the compounding because, believe it or not, let's say someone at my age, I'm 54. If I want to retire when I'm 65 or 64, whatever that is, that's 10 years from now. My capital, if I put that into this fund at 11%, believe it or not, the power of compounding is amazing because within 10 years, that, let's say $1 million will grow to about 2.85 million because our compounding is actually quarterly compounding. It's not annual compounding because remember that we're making distributions. If you're not taking a distribution, it's basically reinvested and then that continues to accrue. So the point is that the returns are better. Can you imagine putting in $1 million or even $100,000, let's say that's our minimum. And within 10 years, it could grow to 2.85 times that without really significant downside because it's all fully collateralized. And on that topic, we also maintain a very strict 150% collateral coverage ratio. That basically means that for every $10 million that goes in, we got $15 million in physical, tangible assets. It's a collateralized portfolio. But I mentioned there's 2 reasons why we keep it in cash and what we do with it. So number one is to make sure our cash is there to be able to pay out on a quarterly basis. And should any investor want to divest and need a capital for anything, they don't have to sit there and wait 3 years. After the 1 year lockup, you can pull out whenever you want, just providing a written notice. I think it's like 30 days written notice, and then we can have that capital back out for you. So it's important for us to maintain cash. Now, what do we do with that cash while it's sitting there? It's not just sitting there, sitting idle. We actually make short-term bridge loans. That's our debt side. And we generate.
How short-term?
Typically a year, 12 months. On the max would be 18 months, but it gets better because we don't lock that money up. We become like a direct lender, but we then sell the loan. So let's say now I make 3 or 4 of these loans and I'm generating 12% interest plus 2 points for the origination and underwriting. So we get potentially 14 points. We turn around and once these loans are done, we package 3 or 4 of them and sell them to pension funds, hedge funds and they're happy to make 9%. So we're essentially creating a spread of about 3% for ourselves, plus whatever we earned on origination. So that's not bad considering.
So you actually are then, you have a loan origination business that you can, inside of the fund, where you can turn around and get your liquidity back really quickly.
Right. So we don't want our money tied up. We need that money available to us, but we don't want it to be sitting there idle because it drags the performance of the fund down. But what this does is, so why I was saying earlier, diversification is so important. Even if you have one property that doesn't perform really well, and this is why I really hate single family homes today. If you buy a single family home and you lose a tenant for a month, your cash flow is gone. I mean, meaning not gone, but I'm saying your net negative cash flow for the year. That's a tough pill for a lot of people to swallow. I mean, granted, they're building some equity, but I don't go to a deal, number one, unless it's positive cash flow. I'm not going in because then it just becomes like, it's like another one of my kids. I got to support that property. I'm not doing that. The property needs to support itself. There are many, like these are little tips that I would tell people is don't go into something. I have many friends, believe it or not, and the same people that I helped recently, many of them back in 06, 07, they were buying condos pre-construction because they were getting, I don't know if you remember back then, but by the time it was done, they were selling, flipping out of these things. But what happens after 08, 09, they're stuck holding them. And at that point, they convince themselves that, hey, it's okay. I'm still building equity, but every month they're putting money in out of their pocket. And it just becomes, and imagine now if you have 2 or 3 or 4 of these properties, you're not really taking home any. Your whole salary is going to support your properties. And then if you have to,
giant liability.
It's a huge liability. And then if you have to sell, you're taking a loss because it's not at the value that it was when you bought it. So these are the reasons why, number one, I don't like negative cash flow situations. I love the way we've structured this fund now because it does provide liquidity for our investors. It provides a really competitive 11% return, especially when you compare it to, say, the market. The S&P 500 over the last 10, 20, well, the last 10 years, it's been better than 10%. But if you look at, especially the last 5 years, it's been better than 10, 11%. But if you look at over the history, it's about 9.5%. If you're getting 11% without that volatility, without that risk, I would take that all day, especially if you're a pre-retiree or a retiree, because capital preservation is of obviously paramount importance. And then second is income. So if you can make sure that your balance doesn't go down, but at the same time now you got a nice strong income coming in, that's the best of both worlds. We had talked earlier, you asked a question about as far as overall allocation and investment and how it works. And I mentioned that if somebody puts in X amount of dollars, it would grow to like 2.8 times over 10 years. So I'll give you a simple, like an actual example. If someone was to invest hypothetically, let's say $500,000, many people have that saved up in their IRAs or 401s. And by the way, people can invest from an IRA into this fund. If somebody has $500,000, within 10 years, that $500,000 is going to become about 1.4, assuming an 11% cumulative. So our fund is an 11% cumulative return, and it's an 11% pref. So what does that mean? An 11% pref means that the first 11% that the fund makes is earned by the investors. It's not earned, nothing is earned by management. We don't have any management fees. So we're not draining your returns with fees. So the first 11% the fund makes goes to the investor, and then we make our money. If there's ever a year that the fund makes, for example, 10%, then we obviously don't make any money. But the second year, we got to give you 12% because it's cumulative. So if you're in the fund, say, for example, invested for 3, 4, 5 years, at least for those first few years, right up until that time, you're basically getting that 11%. So, now if you have that initial $500,000 and it's grown to 1.43, what do you think that equates to at 11%, 1.43 million? It's going to be about $13,750 a month. I think most people can survive on that. That's a decent.
Yeah.
So this is a way that we can show somebody, even if you may not have millions saved, with cost of living so high today and uncertainty with inflation happening, you got to have a plan. And this provides an outlet or an ability to say, okay, even though we might have started late, or maybe we didn't really plan it originally the right way, it's never too late to start. And if you have $200,000, $300,000, $400,000, $500,000 that you can allocate to a fund, especially a real estate fund that's going to give you a nice consistent return, then that's going to grow by the time you're 60 or 65 to a decent number where then you can move from a class B over to a class A, and now you're drawing down. And the best part is you're never depleting your initial investment or whatever that amount is, because that stays, you're just basically living off the interest, right? So now should something ever happen to you, that is going to be willed, or, it can go to your heirs, your kids or your grandkids or whatever. So you actually are leaving something behind of value. And at the same time, you have a comfortable lifestyle without having to compromise your overall lifestyle because now you're retired and you don't have a paycheck.
For any of that income that comes out, what part of that is taxable? And before you answer that, so it sounds like the structure to get into maybe like a chunk down is what if someone were going to something like a SD IRA as an example, because they've rolled that over into an SD IRA, say they've invested and they're getting the 11% pref there as well. So that's obviously going to that SD IRA entity. Is there any tax paid on that?
Well, if it's an SD IRA, then no, it's deferred until whenever. If it's a Roth, it's even better because now you don't have to worry about taxes at all on that. But on a regular, even an IRA, it's treated the same way. You will have a tax consequence, but at the end, not now. But that basically means your money continues to work maximum. The full amount gets to continue to work without being depleted due to taxes. The other thing we're doing is, we talked about 11%. The structure we've set up is very...
Of the fund,
Yeah, the fund. It's
because you have it set up where there's a C corp and you actually get a 1099 with. I was curious about that setup.
Yeah, that's great, man. You've really done your homework. I appreciate that. Many people don't understand because most real estate funds that you go into are typically LLCs, and when you're in an LLC, every year you're getting a K1, right? Now, even if you didn't take a distribution, because you got a K1, if the company, the LLC, made a profit that year, you're going to have to pay tax on that amount, even though you didn't take a distribution. We don't like that, number one. Also, we don't want to give you the headache of having to do tax filings every year for this. So we have created a structure which is similar to like a stock. When you buy a stock and you hold that stock, you don't owe taxes on it while you're holding it. You owe when you sell, when there's an actual liquidation event, or you take, maybe you receive a dividend or whatever the case might be. So the first part of it is, you're absolutely correct. So we have created what's called a master feeder structure. And there are other funds like Blackstone, KKR, and others that have actually set it up similar. And we've got some of the best lawyers and accountants that helped us create this. Essentially, what the investor would invest into is a corporation. So they're getting shares. That's the feeder entity. And then the feeder entity, which is called Propex Income Advantage Fund 1 Incorporated, that feeder entity invests that capital directly into the master fund, which is a limited partnership. And then the limited partnership has the 3 subsidiaries. So for example, Vertical 1, Vertical 2, Vertical 3 are all individual subsidiaries. Now, even those are not LLCs. Some are corporations and others can be LLCs. The one that's a long-term is a LLC because we want that pass-through of the depreciation expense. The other 2 short-term ones are actually corporations. And so that way we can create like a blocker, and we take care of the taxes before it goes up. So it's not like getting double and triple taxation. But it works because that way we can provide much of that 11, as close to that 11% as possible. And keep in mind, until you get your 11%, we're not getting anything. So we had to make sure that it was set up in a way that we can actually deliver the 11% to you. And it's easier.
Okay. That's interesting because what I really like about what you're talking about is that on the income fund, or at the corp level, right? The quote unquote feeder fund where the investor who's listening here would invest into, you're only getting performance. You're only getting something after the 11%. You're only getting a percentage there. And the assumption there is that you're probably making a bunch of more anyway because of the different verticals.
Yeah, I mean, we have to be making more, otherwise we won't make anything. So we know we're very comfortable in, like I said, I've been in this business 25, 30 years. And I know that if it's just my own portfolio, I can easily generate, 18 to 20% per annum without without me taking a significant amount of risk because of the way we buy our properties. In real estate, you don't make your money in the exit, you make your money in the buy. You got to know how to buy, you got to know how to find these properties and procure these properties. So we have now, over the years, have perfected how we get them. We also like tax deed deals. So sometimes they're hard to get good ones, but if you get it, I mean, the profit potential is great. We own a bunch of property in Alabama right now that we bought on tax deeds, and we buy them for pennies on the dollar. We fix them up, and I'm not a big fan, as I said, of single family homes, but when you have a bunch in one area, then it's okay, because then you have one team, a management team, and you have the same contractors, and they keep them busy because they're working all the different properties. But yeah, it all depends. Every market is different. We don't limit ourselves to any one location. So we will go into multiple different markets. For example, California might be in a slump right now, but the East Coast is doing really well. We also like to buy when markets are depressed. That's the other thing we didn't really discuss yet. But when people run for the hills, that's when the deals are there. You got to be, number one, you should have some liquidity, some cash that you can go and take advantage of opportunities. And you have to have the wherewithal, I'm not saying it has to be aggressive, but you got to be willing to take that risk. And it's all calculated. It's not like, hey, I'm just going to take a gamble. But if you've got a market that's maybe depressed and you're getting great opportunities, well, that's the right market to be in.
Right.
And especially major cities. So the other thing we don't do is we really don't go rural America. This is, again, strictly for investment purposes. I want liquidity. I want to make sure that whatever properties I go get into, I'm not going to have trouble. I'm not going to be stuck holding them for a long term. Because in some of these rural markets, you have to wait for that one specific buyer.
You can never get out of them.
Yeah, man, it's tough.
Yeah.
It can. Yeah. So these are things that we've learned over time. We have a really strict set of guidelines. And so even if we have opportunities that come to us, if they're not in a major market, so we don't like to typically go into any city that's less than a couple 100,000 people.
Got it. Well, I want to go back to the verticals,
Sure.
The fund verticals. And one thing we just wanted to check in on for my own curiosity is you're talking about you're in the real estate business, right? And that in the case with the assisted livings, you talk about that there are other operators or there are businesses that are in there. Are you guys, who's operating the business for the assisted living? Is it that you guys have verticalized and are also doing the business side, or are you strictly mostly partnering with other people that are running these businesses?
Yeah, so the fund itself doesn't take the risk of the business, but we, in some cases, yes, I have an investment interest in a company that will actually handle the management of it. But it's not where, you have the risk of the business itself, because the fund and the structure based on our PPM is we're a real estate holding company, right? Fund. And a real estate investment. We adhere to that. We also have an administrator, a fund administrator, that when we have dual cash control. So no money, for example, can go out. Fund administrators, NAV fund services, they administer over $300 billion. So anytime we do a closing, they just make sure that it adheres to what our PPM states and what our requirements are. Otherwise, we can't even go buy a property. So everything that we do is on the up and up in terms of how we do it. And every property that we buy has to conform to a set guidelines. And we know what we're looking for. So this is a formula that we've kind of put together. As far as your question with respect to some of these businesses, in some cases, I may have a vested interest in the actual entity that's owning it in terms of the business side of it. In other cases, we basically just lease it out and we love the cash flow. We just take that.
Yeah. Okay, cool. Yeah, that one with the loan origination one, I hadn't heard that before, but it's so obvious. Like that's how you can originate it if you have that skill set, package it, sell it off, get your liquidity back, and get one time. It's just another, you call it vertical 3, but it's kind of vertical 1.5, which getting able to get big chunks of cash back in while you have these longer term plays, which are holding it down, right?
Think about it this way. If let's assume, for example, the fund has, let's say, again, by the way, we're not a massive fund too. This fund is relatively new. We just set this up recently, but let's assume that we have $10, $20 million. 25% of that is there in that vertical. That vertical, let's assume it's $5 million. Of that $5 million, you're generating 3% every few months, which is fantastic. We don't have any risk, because once we do that deal, we offload the loans, we're back into cash, and we've already built ourselves a 3-point spread, plus the earnings that we get from the origination side of it. Yeah, I mean, it's the best use of because we knew that we needed to always maintain cash for those two reasons. One, we want capital there for the ability to strike when an opportunity presents itself. And two, we want to make sure there's capital available for investors should they ever need to pull money out. So these are some of the biggest advantages I say as far as PropTechs, is the fact that you have better liquidity than typical real estate funds. You've got a very competitive return compared to other investments, not just in real estate, but even other investments.
Yeah, awesome. That's really cool. Look, we only have a little more time left. I just wanted to ask one more thing to put a cap on this part and then pivot topics. Sure. And we give the example of someone has the 500K or so, or some amount that get its return for the next 10 years, 20 years. That's a great strategy. Does that work? What's the think on a minimum investment capital that they should come with?
So our minimum, Steven, is 100,000.
Right.
And then after that, I mean, it's up to every investor is
Right.
different, right? I mean, depending upon what their background is, what their previous employment, how much money they've saved up. We've got people that I talked to one guy just last week. Right now, he's like, I want to put in about 4 million. And I was actually taken aback because he would be our biggest investor, but he has a
Yeah.
company that he's selling. And so I thought maybe but he's getting, I think it was like 10 or 12 million. So he's like, I want to put, and he's very specific. He's like, I need to be able to make $40,000 a month. And I'm like, oh, okay. I
Right.
mean, so I'm like, well, who has that kind of a lifestyle? You need to be able to get $40,000 a month. But this guy knows exactly what he wants. He knows how much he
Right.
has and he wants to put it in. We have different, but most of our people are in that 2 to 250 range, which is, it's most people, especially in tech. I mean, the salaries are great. People have saved up. I'd say probably if you're looking at tech, most people would be in that $300,000 to $500,000 range. And I also don't believe you should put all your eggs in one basket, right? I mentioned that earlier. So you should have exposure to other investment classes, other asset classes, whether it's maybe a little bit of precious metals. I mean, we've seen gold and silver done incredibly well over the last few years. And it's a hedge, if you will, against the market and against inflation. So I would actually advise it. Even real estate is a great hedge against inflation. But I would say a little bit of allocation even today. Like for me, I got about 10 to 12, maybe on the max side would be 15% allocation in the actual stock market. But the majority of my stuff is in real estate, and also not all of it in this. And I also, in this particular fund, I've got $2 million worth of my own assets. And I'm like, okay, in 10 years, that too could become almost six. And I could get a very healthy on a monthly basis type of returns. We're very comfortable with where we're at in terms of what we've created. It meets, I think it can address the needs of people who have been saving for a long time. And also at the same time, for those who have not, it can give them a plan to get to where they want to be when they're retired. The key is you got to take some steps, whether it's today or tomorrow. If you're planning to be retired soon, you've got to now start taking some steps, either maybe meet with a financial planner, figure out what allocation you want to put in towards something like this. Or if you want to buy your own real estate property, you could do that too. One other thing I'll tell you is most funds in general, as an investor, you'll rarely ever get a chance to talk to the fund manager. We're not like that. Every one of my clients has my mobile number. So they can not only call or text. We believe in relationships and also being available, approachable. So that's super important for us, which even I, as an investor, had oftentimes had trouble actually talking to the actual fund manager. Number one is because obviously we're not that big. We're not like a $1 billion fund. And I also don't have intentions of getting it to that size right now. I mean, keep in mind, remember the origin or the genesis of how this happened. This happened because I'm helping a few friends. And then we decided, hey, it's just not practical for me to be able to do this one-on-one. Let's set up a fund. And then now here we are. And I love it because now I'm helping more than just a few people.
Yep. Is this feeder fund, is it going to that LP,
Mhm.
that bigger LP? Is that under your guys's, is this partners or under your?
No, it's all the same. So Propex Capital Management is a management company for both. It's like a top-down approach, right? So the capital goes into the feeder fund. From there, it's funneled down into the master fund, and then from there, it goes down to the three different verticals. So it's all
Cool. Clear.
Yeah.
Cool. Awesome. Right on. Hey, so you're in Bombay right now.
I am.
And you're telling me that in addition to being here to talk about to tech professionals, you're there because you have a software company as well. Is this related to building the MLS or is this something else you got going
Yeah,
on?
no, it is. It's related. So I do anything and everything to do with real estate. As we said, we've done all different types of investments from multifamily, single families, commercial property, et cetera, and also prop tech. And this opportunity kind of, you got to keep your eyes and ears open, right? And as I said before, I'm an entrepreneur. I came here about 10, 11 years ago, back in 2015. I had come here because I had a small company, a tech company, like programming and software, and that I had invested in. And I was basically outsourcing projects from the States to India. The gentleman that worked for me, we had started a project and I had hired him away from Motorola many years ago. He was in Florida at the time. We built a company in the States and then he had moved to India, specifically Hyderabad. And he had set up a company and now we had a small team of maybe, I think, 5 or 6 people. Nothing big, but we got to a point where we were needing more space and we were ready to hire more people. I had gone to
Yeah.
India to look at, I had already called ahead to talk to a few brokers and say, hey, listen, I'm coming and this is what I need. I need a couple thousand square feet and I need redundancy, power, internet, et cetera, right? And
Sure.
I get down there and I was shocked, man. We're blessed. We live in America. We have all this data at our fingertips, believe it or not, 90% of the world does not have the plethora of data that we have that's available to us. Long story short, I asked these brokers, and believe it or not, they're using WhatsApp groups. And this is when WhatsApp had just kind of started. And at that time, nobody even in the States was using WhatsApp, by the way.
2015,
nobody was using WhatsApp. But in India, people are using it. And they were using it, I would say, a large percentage. And so these brokers would set up little groups. And then they would just put in there, hey, I've got a client who's looking for they call it a 2 BHK. That means 2 bedroom. But they say, I got a 2 BHK or a 4 BHK, or I have somebody who wants a 2,000 square foot office space, whatever it is. They put it into this group. And then the other people, they'll scroll if they happen to see something. So it's super inefficient.
And forward it.
And then they got to take that and then forward it. But the thing is, there's no pictures. You might have one picture that you can show. It's just it's not practical. It was not practical. So these brokers, they didn't have their stuff together. And I know the business. I'm in real estate in the States. I'm like, guys, they're calling people, other brokers. The guy had me sit I actually went to a RE/MAX office, believe it or not. And I figured, okay, this is a used company. I know them. I'll hopefully so I worked with 3 different brokers. One of them was RE/MAX. I sat in the office for 45 minutes while the guy was in the back trying to find properties. This is after me telling him before that I'm coming down. But anyway, that was a very educational experience for me, because while I was sitting there, I was talking to the receptionist lady and finding out exactly how they do it. And I'm thinking to myself, why is it taking so long? Well, long story short, what I ended up doing was I realized that there was no MLS in India. So we did about 4 months worth of feasibility studies just to see. Like, I couldn't sleep that night. I'm thinking to myself, holy cow, there's no MLS.
Yeah.
The opportunity is incredible. Like, look at opportunity, right? Zillow is worth billions. CoStar is worth even more, billions. And CoStar is almost like a commercial MLS, because they also own the B2C, they own the B2B, they own LoopNet, and then they now own apartments.com, et cetera. So we built our company very similar to CoStar. So we own the difference between that and the residential side. Zillow is just a B2C. It's a consumer facing portal. What Zillow does well is they created a brand, and they know that, listen, we're not going to worry about managing the data. We're going to tie up with all the MLSs, which they did. And so when a property status is updated on the MLS, it automatically is updated on Zillow, right? Because they have that link direct to it. What we did was something similar, but the difference is that we didn't want to be at the mercy of another company. So we said, okay, we're going to build the MLS. Today, we have a fair amount of data. We've got about 12,000 users, which is really nothing compared to where we want to be. So in the next couple of years, we're going to hopefully 10x that and get to a point where we have a couple 100,000 users, 100,000 to a couple 100,000 users. That's when you have really true value, because with the MLS, the value comes from actual amount of data, right? It's if you don't have enough data that you can process and enough property listing information, there's no real value. So it's important for us to get large number of brokers on the platform. It's important for us to get a large number of listings on the platform, so that now immediately our system, it starts doing its matches, right? It's almost like a dating service. It matches buyers with sellers. And the way I explained it to these guys here, because they didn't understand, what is an MLS? I said, imagine your WhatsApp group. Now imagine putting a search bar at the top. And you just say, look, I want a 2 bedroom in this location at this, in this price point. And then boom, it takes all the other garbage out and you're left with these 5-6 properties. Like, wow, that would be amazing. I said, yeah, that's exactly what we created. And so that's how it's easy. You got to talk to the language and say, look, this is what we're going to do. Yeah. So to answer your question, I am in Bombay right now. We're taking it global. We're going to go to we're in India, we're going to Philippines. I was invited to speak at an international realtors conference a number of years back. And I was invited by NAR, which is the National Association of Realtors in the U.S., because they were part of one of the groups that were putting it on. And they knew that what I was doing in India. So they said, hey, Jay, can you come out and speak at this thing? Would you believe that and by the way, they had only given me an hour on the opening day. And it was like just before a lunch break. I finished that hour, and then I had all these people rushing, and I thought I said something wrong. Like literally a bunch of people came up to the stage as I was coming down, and I realized they all were fascinated by this concept of the MLS. The organizer of the event gave me another hour on the second day to do Q&A, and because nobody had a chance to really interact and do a whole Q&A session. The third day, I got another breakout session for people that wanted to see a live demo. So it shows you that the interest is there, the demand is there. So we said, okay, we're definitely going to embark on this thing in a big way.
I always find this so fascinating, right? Because I forget the names of these people now, but they were somewhere in Europe and they would look at the type of businesses that were happening in the
Oh
US and they
yeah,
would
they're
do
these
the
brothers, the
same
German
concept
brothers.
with
There are three guys.
yeah,
One man, they've made a
exactly.
fortune. There's actually they essentially copied eBay, they copied Amazon, they copied,
Yeah,
and they're worth
right.
billions today.
I know.
So we
So
essentially we're
this
doing the
kind
same
of
thing. We're copying the MLS. But although I'll tell you something, I showed the brokers in Chicago what we have created. I also currently hold a managing broker license. I don't use it. I haven't sold a property in a long time, but I like it because it gives me access to the MLS. But I show them this, and it's our MLS that we built for India is better than the MLS that we have in the States. It's just the one that's in the States, it's a little bit archaic. They make small updates here and there, but it's the same product I've been using for 20 years. Whereas
yeah,
here now, when you're building something new, you're going to build it with all the bells and whistles. But that also was a
21st
bit of a
tech.
mistake we made. When we first built it, we thought, think about it. If you're going to build something, you want to build the best. Well, there's a problem because now you're building a Ferrari and giving it to somebody who's never really driven like a basic Toyota Corolla.
That's
And
right.
it was too much. So we had to, lack of a better word, maybe dumb it down a little bit to really simplify it. But so that was one of the mistakes we
Yeah.
made. But yeah, the point is that it's a viable product. It's need of the hour here.
Yeah, geo arbitrage in a different way, and you're talking about there too
Yeah.
with the product we've made is that it really you get to, from a software perspective, you get to go through that whole cycle again of product development. What are the minimum viable product they need to really get going with it and scale your?
Yeah, that's your MVP.
12
You got to get that your minimum viable product there that you can get out there, and that's what we did. We had to put something out there that we knew that people can understand, use it. The other problem you have is when you go into these type of markets, humans are creatures of habit. They don't necessarily want to change and start. So the older generation,
incentivize.
right? The older generation were not ready to do it. But I'll tell you something. Now, as you're seeing this change, by the way, when we did it at that time, it was still a little early. We're seeing better traction now because of what's happened in the overall market, the internet, and everything else. And
Exactly.
everybody in this country runs the entire real estate market runs on the phone. It's a mobile app, as opposed to like in the States, we all have our laptops. We go back and people have iPads, or whatever. But no, in this country, everything is on your mobile. So people carry two mobile phones around, but everything's on your mobile.
Yeah. Yeah. I mean, there's principles around this. The other classic one in Ford, if I would have asked people what they wanted, they would have told me a faster horse. So you need to go through this whole journey as well. But fortunately, I mean, tech and cloud and just the integration of it is so much more too with AWS and other people, other providers getting more and more connected. As more people get connected, more mobiles, more just tech in there, it becomes that much better.
I agree.
The timing kind of is right. And
timing is everything, man. You can have a great product. If you put it out the wrong time, you're going to fail. You can have a subpar product, but if you put it out at the right time, it's going to be in high demand. So timing really, it's one thing I've learned, part of my 30 years in business. Timing is everything.
What are you excited about looking? I want to ask something along the lines of a book, body of knowledge, that kind of thing. It seemed like the book is such a dumb question, I think, here, because there's so much, it's too narrow. But what I think the 3 or 4 questions behind that question is, this is obviously an exciting project. It's something that you need to keep on working with the team to build and develop on. But what areas of topics are you really excited about right now?
And
is it about tech things? Is it about AI?
In real estate, I love AI. I mean, I think we're actually incorporating AI into our MLS too. It's amazing. Wait till you see the finished product. It's gonna do everything for you before you even know you need it. It's incredible. We not only that, we use AI in my business in the US as well. So yeah, as far as what we're doing and where we're going with that is I'm basically facing and incorporating AI into our overall business.
Totally. I guess what I'm saying is, what topics are you sinking your teeth into right now where you're just obsessed with? What's your current obsession? Let me put it that way. Or is that just the products you're on?
No, I'll tell you, that's a different topic completely. I mean, if you want to know what my real current obsession is, I love real estate. Real estate's steady. Real estate's consistent. But I've been working on something on the trading side. I touched on it earlier, which is blowing the pants off of everything else that we're doing. But obviously, it comes with a little bit more risk compared to the real estate. But if somebody has an appetite for taking a little bit more risk, they're getting double the returns, like mid-20s type of returns. And we've got it structured in such a way that we do protect 90% of the downside. It's a fully hedged strategy, but you can never say 100% because number one, I legally can't say it. And two, is the market is still a little bit unpredictable. But at the same token, it's almost like an algorithm type of system that I've been working on for over 10, almost 12 years. And I love the numbers because what I do with 11%, like I said, you can, with 11% in 10 years, you can get almost a triple on your money. Now imagine if you could double that from 11 to 20 to 24, 25%. It really shortens that curve.
Compounding.
Yeah, compounding. I mean, I love the power of compounding. I mean, it's beautiful. Yeah, I mean, that's, if you say, what's my obsession right now? Real estate's great. I love it. My team does, we have a strong team right now. We've got a team that focuses, we have a team that handles just acquisitions. We have another one that does underwriting. We have another one that does the management of the properties that we hold as far as our long-term portfolio.
Mhm.
The short-term stuff we end up just selling, right? We get out of that. But there's a long-term portfolio that people manage. And then the last is dispositions, and that's the sales side of it and getting out of the properties. But yeah, it's like a machine, right? Nothing should be dependent solely on me. Even if tomorrow, like for example, I'm traveling, going to whether it's India or the Philippines or wherever that case is, our business doesn't slow down. We still continue. I've got even my kids involved. They're getting into it. So they're in their mid-20s, pretty much the same age that I was at when I started. And then we've got a lot of experienced people in there as well.
That's fascinating stuff. Where can people keep up to date with what you got going on?
So our website's Propex, Proptex.com. It's kind of, I wouldn't call it an acronym per se, but it's short for, Prop is short for property, T is for technology, and EX is for expertise. So nowadays you got to create your own word to get a .com. I mean, it's like, there's no .coms available, but we like it. That's how we created our brand. So it's Propex, Proptex.com. And then if you want to find me, we also have, look, I'm a little old school. So I'm going to be honest when I tell you, I'm not really much into social media. But people have told me, obviously, we need it. So we do have an Instagram handle. It's called Propex Funds. There's a few posts on there you might find interesting. But then we also have, my LinkedIn has some information. I was putting out some newsletters and things like that on there. You can find me on LinkedIn under Jay Patel. There's probably a lot of Jay Patels, but you'll find it if you put it with that and either Propex and Jay Patel or MLS and Jay Patel, you'll find me on it.
You can go to the show notes. It'll be there too.
Yeah, cool. It'll be on your thing. Yeah, awesome. Yeah, listen, I really appreciate you having me on. And if anybody has any questions, definitely tell them to reach out to me. We're always available. Happy to answer any questions.
Yeah. Awesome. Thanks, Jay. This was a lot of fun. Need to hear about that structure and break it down as well from the corp side, how it goes into the LP or that limited partnership and the rest of that structure, to seeing the opportunity from that experience of talking to the receptionist and going over there and everything's done by WhatsApp. Like there's something to be done here, right? And you've definitely, you talk about, I wouldn't say old habits, but old loves die hard, if I can make up something here about the trader at heart. But you talk quick, you're thinking fast, and you're no doubt acting fast with your team as well. It's a pleasure to have you here as a guest.
I appreciate it, man. Thank you so much. If you ever want to chat about something else or maybe do a deeper dive on the MLS stuff, I'm happy to do that with you.
Yeah.
Cool.
Thank you.
All right, buddy.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in the future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.